All right, welcome back to another episode of Can an Income Portfolio Sustain an Early Retirement? For those of you who don't know me, my name is Tony. I decided to early retire off my income portfolio back in 2024. I have been documenting, withdrawing, and living off of the portfolio. The reason I'm doing this is because back at the time I wanted to look for data on people who actually had live off the income portfolio and income strategy. But a lot of people are actually in the accumulation phase and they're more like reinvesting everything. So I couldn't find a piece of data that would kind of help me feel better about this strategy myself. So I thought that since I'm doing it, I want to be that piece of data that I was looking for at the time. So I decided to track my withdrawal and how my portfolio grow, and I compare them with the other popular strategy like S&P 500, Nasdaq, Global Diversify, or other popular income ticker to see how it would have performed in comparison to other ticker if I were to go with a different strategy. So with no further ado, let's get into this month. A lot of things has happened, so hopefully everyone is doing well with their portfolio. We have crazy uncertainty with, the SaaS apocalypse, bunch of like a crazy fear on the tech name, mainly the SaaS name, because the fear of AI taking over. So we see a lot of uncertainty there. We also see a crazy oil spike due to the war in Iran, and then market was really uncertain until this week. We have reached somehow an all-time high on our S&P 500 and also Nasdaq as well. I think the market's surprising in that we're coming to a resolution soon. So markets are slightly forward-looking. So basically, everyone kind of I feel like there was a lot of money on the sideline waiting to pour in, and on you can see that a lot of volatility was started to come down as we can hear we get more certainty on like that the conflicts are starting to fade away. So money start pouring back in. We made a big change in the portfolio, so let's take a look at them. So our portfolio have reached all-time high as of today is 1.168 million. This is despite withdrawing consistently every month from portfolio. So I generally withdraw about $4,000 to $5,000 a month just to live from the portfolio. We have a lot more expense lately, so we've been withdrawing a lot more. Our cash is dwindling a little bit, but then we'll be looking into building that back up. So I'm not going to go into how I structure my portfolio. If you're interested in that, take a look at the older video. But our core holdings is mainly going to be like a growth factor. So we're not really withdrawing from this. We're just going to let it grow, compounding on itself. So far, it's doing well, reaching 470. Living expense, as the name suggests, everything from this part is being withdrawn out. So far, because we withdraw so heavily from this part, I don't expect it to grow too much, but so far it's holding out well. We right now withdrawing about 16% per month, which is very, very hefty. So I expect this portfolio to not grow at all, and slowly over time it might even diminish in time. But basically, I expect that eventually, maybe 10, 15 years down the road, this portfolio gonna slowly diminish, but our other portfolio will grow and then replace that part, and eventually we'll combine everything, and then so on and so forth. So then the margin account, this part is going to be a little bit more active trading. I wouldn't call it like a day trading or anything like that. It's a part where we use margin to take a chance on good opportunity I see in the market. We made a big change over here. If you follow the video last month, we had a lot of fixed income ticker that I sold out all of them out. Well, I mean, I still have BPY to PA because I couldn't get a good feel on it. So I'm still looking to liquidate this one. Um, Basically, what happened is I see that market is getting a reversal. We are seeing promising news on the conflict resolution, so I decided to sell all the fixed income. So how preferred share works is that they have a callable value, usually of $25. A lot of preferred share was sitting at $20 to $23, and it was very close to callable value. So the upside is, without being too technical, the upside is very limited, and we already realized most of the upside. So I decided to sell all of them and then reposition them back into a more stronger growth name. Namely, I did buy some Amazon. I did bought a lot of leaps. So before that, let's take a look at this part. So this is what I have currently. You can see that I have some Amazon leaps. This is basically a long leap expiring in 2028. I do have some Microsoft sell put, Oracle sell put. So how I structure these one is like a spread, right? So basically I sold put on Amazon, 3 years out, 2.5 years out, and then I used that proceed to buy a call. So basically, the cash reserve doesn't get touched too much, and then I still get to maintain a delta of closing close to like a one. So in layman's term, it's designed to not take a lot of cash, and then it still move similarly to actually holding a shares. Not exactly, of course. So a lot of these moves gonna seem either very smart or very stupid down the road, depending on how the market plays. But so far, I feel like we have bottomed out, and so far this has done really well. Um, so I sold out all the preferred shares over here. You can see we actually made quite a good gain on them. I bought a lot of these back in 2023, and then we have realized a pretty decent gain. Let me just move myself out a little bit here. So we have realized a pretty decent gain on them. So definitely going to be a big tax bill end of the year, but then again, these are mostly capital gain tax. And oh yeah, about this year. So some people wondering how the tax would work since I'm doing such a heavy income strategy. And so far this year, after filing the taxes, I actually don't owe any taxes, which is great. I think because my wife's not working, we're actually living off this. We have a lot of eligible dividends and some write-off. Nothing major, but because of the a lot of them are ROC, return on capital, which get taxed very differently upon you selling, not so much on the payout. And a lot of payouts also capital gain. A lot of them is also eligible dividend. All in all, I didn't end up have to pay any taxes. Originally, I expected to pay about 4,000, but end up not having to pay any, which is great. Okay, so far this is just for the margin account. Okay, as you can see, we pivot. I think somewhere after end of March, I think the first week of April, and then we try to reposition ourselves to try to capture as much of a rebound as possible. So far, it's working out really well. We have managed to capture quite a bit of a swing this week. So let's talk a little bit why Amazon. So I feel like Amazon is a big, it's a very solid company, big tech name. Without going into a more technical, I feel like the price has been suppressed, and I feel like Amazon's a stand to get a good benefit from all this AI revolution that's going on with with all the segment that they have. Even like the retail segment, even like the AWS. So I think that Amazon's going to be a good place to be. And then with how big they are, I think they're also quite safe. Of course, I don't want to get into too technical because this is not what this video is about. And then Oracle, Microsoft. Oracle's is basically the price has been shot really hard due to the amount of debt they've been accruing, but I feel like the demand is already set for them. And also, people also worry about the OpenAI commitments and stuff. So I feel like this is a pretty good risk reward trading. Of course, it could still go wrong. But anyways, I don't want to talk too much about them. So yeah, so far it's done really well. Anyways, let's take a look at our comparison portfolio. So let's go to VFV. VFV actually rebound as well. So far VFV is sitting at $1,033,000. Originally, when I first done this experiment, I actually expected VFV to be the top performer because of growth are usually going to beat out the income and other strategy. But I think due to how the market has been and how the currency has shifted back and forth and all this uncertainty, VFV actually, funny enough, actually the worst performing out of all portfolios, so which kind of show that you can never take anything for certain. I also documented all the withdrawal over here. Um, so far since the beginning of the experiment, we have sold about close to 400 shares. As you can see, share price are being slowly declined over here, and this is by design, right? So it's gonna how it's gonna be like this. How it works with the regular strategy, you expect that amount of shares sold is gonna decline over time. So maybe 10 years down the road, you might only have to sell 4 shares to fund your monthly expenses. Okay, next part is HYLD. For those of you who are not familiar, HYLD is basically a US-based cover call strategy with a layer of 25% margin. It's a very popular ticker for among the income Canadian group. HYLD, originally I actually expect this one to perform the worst, but so far it actually beat out VFB quite a bit. Partially because of margin, HYLD actually dipped more than VFV during the crisis of oil the past month, but also rebound much better. So far it did beat out VFV. Again, by design, because the HYLD pays so much, I slap a 10% tax on it. Um, you might agree with it, you might not agree with it, but because it pays so much, I feel like it's unfair to not charge it tax at all. So it's sub 10% on it. Then by design, we HYLD still pay a lot more than we spend. So as you can see, the share price gradually go up. This is my share bought each month. So far we have bought 5,720 shares since the experiment start. HYLD share is sitting at 32,000 shares. And then share price is going to continue to go up by designs, unlike VFV. Sorry, I'm catching my breath a little bit. And then next one is XEQT. For this one, is a very popular ticker among Canadian investor. It's a global diversified, so basically you got a good exposure to Canada, you got exposure to US, but also got a good exposure to around the world as well. It's like a one-stop shop. HYLD actually proven to be a lot better than expected. It might not have the best growth in the long run compared to the big name like VFV or the Qs, but it showed that the resilience of the diversified strategy where it has the least volatility, and then I would have to say that in terms of risk-adjusted return, XEQT definitely hands down the best so far in this experiment. XEQT a little bit tricky to track because of it does pay quarterly dividend and the amount fluctuates, so I have to do this by hand. So as you can see, sometimes you have to buy shares, sometimes you have to sell shares, so the numbers are very like all over the place. And so far we have sold 1,113 shares since the experiment start. XEQT so far is definitely the dark horse. I actually expect it to underperform VFV, beat out HYLD, but so far up until the past week, this was the best performing out of all the ticker that we track. And then lastly, QQC. This is the Nasdaq 100. It's a very tech-heavy index, which usually means that it has the strongest growth. But of course, the past month, this one also have a lot of SaaS name which get hit pretty hard. So far it's doing okay. It has a $1.16 million ending number right now. Again, this one pay quarterly dividends, so it's a little bit all over the place in numbers. Um, by design, share price is gonna slowly decline, and same thing with VFV, is gonna slowly sell less shares over time in theory. So far we sold 1,627 shares. The amount is still growing steadily, so which is great. Okay, so going over all the portfolio, let's take a look at on the numbers side by side now. So this is side by side number. I start tracking back in November of 2024. I actually retired back in June of 2024, but I didn't start tracking until November. So the starting number is about 932, and then I track all the cash holding, amount withdraw each month. So this is the end result, right? So you can see that the number kind of growing steadily across all accounts. So basically, so far we have withdrawn total of $80,000 roughly across all accounts. So the withdrawals are matched across all accounts, and then we kind of compare the number here. The past few months we've been withdrawing a little bit more than usual due to expenses and some other factor that I would want to get into. I did play around with the Wealthsimple feature of selling put on my Wealthsimple account, so I did take out a little extra cash from there. So so basically anything extra I'm gonna put in a note over here. Okay, so let's take a look at the graph here. I put it side by side as a graph, so I think it's kind of I like and nice to look at for me. Okay, as you can see, this is the Liberation Day dip, which is dipped quite hard over here. Um, This graph is a monthly snapshot, so it doesn't capture a full-blown effect of the Iran war, unfortunately. So basically, as you can see, our account only dipped down to 1.106. The account's the blue line over here. But in actuality, during the worst of the war, it actually dipped all the way down to I think like 1.02. So technically, it would be down all the way here, like all the way somewhere around here. But because of it rebounded by the time we take a snapshot, so you don't see the full extent. So it was a candlestick. It would be like a big candlestick down over here before it rebounded back over here. So it was a very volatile month. Um, HYLD actually dropped much lower than VFV during this time, but by the time we take a picture of it, it rebounded. And as you can see, XQT actually has the most smooth kind of smooth sailing during this time. It dipped a little bit, but barely anything. So if you're an XQT, you don't like volatility, you definitely sleep well at night, even during these conflicts, right? So it kind of goes to show that sure, we might be having more return, but I have to give props to XQT over and over again. That is actually has the best risk-adjusted return during the downtime. That's why I'm kind of contemplating getting the ZEQT.T. So basically, this is a BMO, same concept as XQT, but then they adjust the share selling for you and they pay you out about 6% per month. So I'm kind of debating on that. I think it's probably going to be looking to get into some of those, but I still have something to iron out before I decided to pull the trigger. So yeah, that's all the number we have for this month. Um, Life stuff, not much news. I'm just staying home. Usually that hasn't really gone much. If you follow my story, you probably know that my mom's is going through a cancer battle. So it's honestly, originally in 2024, I actually planned to take a sabbatical, just basically take a long time off and go back to work. But my mom has been, she was a hardworking, like a typical hardworking immigrant story. She worked her whole life, and then she was supposed to retire last year, and then she was diagnosed with cancer leading up to retirement. So imagine, working hard your whole life, and then you decided to finally retire, and you get hit with cancer. It really put life in perspective for me. That like life is short, and then you can't just work so hard, sacrifice everything, and hope that you're gonna get that little reward in the end. You kind of have to enjoy every step along the way, and you can't really take your health for granted. So you gotta take care of your health. And yeah, I mean, sorry, I didn't mean to be a downer, but it's just something that really put life in perspective for me. So I decided to pull a trigger and just what, I'm just gonna go with this, spend some more time with family, enjoy life a little bit more. We don't really, me and my wife, we're not really the type to spending crazy money, and we live fairly minimal. So far it's been working out well for us, and in the end we can always get another job if we decide to. So that's why we decided to go with the direction. I know some of you might not agree with it. I get a lot of like a big question mark when I post it on Reddit and stuff because people feel like is not the most optimal strategy, which I agree. If you are young, you're not planning to retire too way later. I think in the long run, growth strategy always going to be more efficient. And then some people asking, why don't just put in growth and just sell what you need to sell? And on paper, I absolutely agree with whoever said that. But my thing is that, can you just picture this, okay? You spend your whole life, you know, investing every penny you have extra. You invest everything, sell, you don't sell. You're supposed to just dollar cost averaging every month. Selling is like a taboo in your mind, basically. And then suddenly, the moment you retire, you're supposed to be like, you know what, I'm gonna sell. I'm gonna start selling now. 4%, like every month, I'm gonna sell methodically. For me, on paper, that sounds very systematic, but in reality, you can't do it. I just can't do it. I can't just be like, okay, market's down this month. Okay, I'm supposed to sell 4,000, $5,000 worth. I'm just knowing myself. I'm just gonna be like, I'm just gonna kicking and pouting, and I'm gonna end up trying to delay my selling. It's gonna eat me up inside. It's gonna cause me extra stress. So in a way, the mental effect that this is gonna cause me is gonna affect my quality of life greatly. So with this strategy, I sacrifice maybe a little bit of efficiency, but I get a better peace of mind in that sense. I'm not sure if I explain this well, but I hope you get a picture of where I'm coming from. It's you know it's it's more like something that you can say easier said than done, basically. Okay, now I want to get into too much of a rambling. So I hope you guys are doing well this month. Hopefully everyone's staying safe. The weather is getting nice outside. Hopefully you get to enjoy sunshine a little bit, and hopefully everyone have another good month of investing. I'll see you guys next time. See ya.